It's been an interesting, turn of events. Whatever could go wrong, I guess, has gone wrong this year. Crude, long-term taxation, trade war, strength in dollar, decline in emerging market currencies, but the index is at an all-time high.
Yeah, well, I guess these are the kinds of things which can always perturb you in the market, and also a reason to therefore focus more on fundamentals and not get carried away with all the news flow. I think remains a bit of a challenge in terms of the fact that valuations are not particularly cheap. We are seeing good momentum in the economy. All the high frequency indicators point to that. The outlook is for reasonably robust earnings growth in 2019, though to be fair, it's coming off a very weak base, so one should not read too much into that forecast at this point of time. But I think markets have certainly surprised by exhibiting a great amount of resilience, as you said. We have not seen any pushback, despite the fact that bond yields have moved higher by more than 100 basis points over the last 1 year. We've also seen a lot of emerging market economies and currencies, markets come under pressure. But yeah, I mean, India just seems to be holding up much better than what one would have expected. But to me, valuations remain a little bit of a headwind and something to worry about.
Vetri, so, in general, one side is the liquidity argument, which still remains strong, whether it is local or global. On the other side, you have the valuation, the growth argument, which is still divided. So how does one balance in this kind of an environment where for a fund manager, there is a compulsion to invest because you're getting fresh inflows. But on the other side, the fund manager is also cognizant of the fact that, valuations are not strong and supportive. So the entry points from these current levels may not offer superior returns. So how are you balancing that?
It is a bit of a challenge, and at this point of time, the best you can do is sort of look for where the best relative value lies. And essentially, it's at least from my point of view, a little bit of a two-pronged thought process over here. One is to look for companies where our confidence level in terms of their growth outlook remains quite strong. And even if therefore valuations in some of these cases are slightly pricey, we are hoping that their ability to deliver earnings growth over the next 3 to 5 years will take care of some of the potential headwinds from their valuations. Also, if you dig pretty deep, you will find that there are some parts of the market, maybe just a few stocks in select sectors, where valuations are trading slightly below longer term averages. Maybe return on capital, return on equity is slightly depressed for a multitude of reasons, and there is some reason to believe that in these places there is a little bit of valuation comfort combined with potentially some hopes of a cyclical turnaround. So you try and focus at these two angles, but really at this point of time, it's more about taking relative calls rather than really finding great bargains out there. I think bargains turn up every once, twice, a few years, but that tends to happen when you see the market sort of sell off 15-20%, like what we saw in perhaps the early part of 2016, which was the last time where you could sort of trawl the market for a large number of bargains. But we're not in that kind of an environment, and therefore relative plays is the best you can sort of try to allocate to. But I think as far as investors are concerned, what we are clearly seeing is that there is a reasonable amount of appetite for some of the hybrid strategies, and people are allocating to hybrid strategies, which in one way helps them sort of deal with some of the challenges related to valuation on the equity market side. So the choice of product that you use to gain exposure to the markets could also help you sort of navigate these challenging times in terms of valuations.
How concerned would you be about the current account deficit? Because we were just chatting with Jonathan Garner from Morgan Stanley, and even Richard Sharma in his interview to the Economic Times over the weekend said that while he's not too perturbed about the currency weakness that he says is an emerging market phenomena taking place, and there's the mighty dollar that we all have to beat in terms of a currency move. But he said, yes, look out for the current account deficit because that may get problematic eventually. Would you be too perturbed by that too?
Not at this point. I'd sort of echo, I think, the comments that you mentioned from the other gentleman earlier. But certainly it's been our Achilles heel in the past, so we can't completely ignore it. The fall in the value of the rupee, in a sense, is tracking what's happening to other currencies as well. And also, arguably, it's coming a little bit late, but thank God, because I think a lot of domestic exporters have been facing the brunt of a currency that was holding up very well, and they were experiencing pressures from inflation. So in a sense, the resetting of the currency compensates exporters for the loss of competitiveness because of inflation. So not too worried at this point of time, but it has been our Achilles heels, and I'm sure the policymakers, the RBI is watching it. And if you remember the last two policy statements of the RBI, they did kind of hint at the fact that global events are something that they've got their eye on, and the transmission channel for what happens over there in terms of the impact on our markets is typically through capital flows, because those are a lot more volatile, and therefore funding a large CAD could become a challenge under that environment. So I think RBI is a bit ahead of the curve over there. They've started to act early rather than leave things for too late, though they've come in for criticism on their interest rate hikes. But I think that sort of reflects their own thought process of the need to take out insurance before you actually hit a serious problem. So yeah, not too perturbed, but yeah, I mean, keep an eye out on that. And certainly from an equity market point of view, remember that the fall in the value of the rupee is actually pretty good from an earnings point of view, because depending on how you calculate it, close to about half of the Nifty earnings actually benefit from a falling rupee. So there is some sort of support coming into earnings from the falling rupee.
Vetri, a large part of the story with the markets has been managing the mid caps and the small caps and the volatility thereof. How have you approached managing the mid-cap fund at UTI to ensure that the downside is mitigated?
Well, if you are in equities, beyond a point, there's no way to really mitigate the downside. You will participate in the volatility of the market. All you can do is try and invest in quality of companies where you think that they can come through a difficult time and do much better when the cycle improves. So I think that thought process of investing in companies for the UTI Midcap Fund has always been in terms of investing in good companies, but those going through difficult times, and therefore that thought process doesn't change. As far as midcaps in general are concerned, honestly, I think we're making too much noise about this. If you look at the performance of the Nifty and the midcap index year to date, one is up 8 or 9%, the other one is down about 8%. So the relative gap is about 17%. And everybody's making a ton of noise about this. But go back to calendar 2017, and the difference between the mid-cap index and large-cap index was actually 20% for the full year. But nobody complained about it because it was 20% in a direction that everybody enjoyed. So these kind of divergences in performances are par for the course. If you look at a 10-year period or a 15-year period, the mid-cap index outperforms the Nifty, but it outperforms it by about 2 to 3% a year. If you look at the last 5 years, it's actually outperformed the Nifty by about 7.5% a year, which is a humongous level of outperformance. So, I think what we are seeing this time is a market where, we first diverged in one particular direction, and now we are starting to course correct that to some extent. So this is all pretty much par for the course.
How much